My name is Maria Pearman, and a bit about myself. I'm a principal at GHJ, which is an accounting firm headquartered in Los Angeles. I'm a CPA, and I specialize in beverage alcohol. I focus exclusively in beer, spirits, and wine, and I lead the beverage division for our firm. We have a pretty strong practice within food and beverage, and I cover the beverage part of it. I've spent 15 years focused solely on this industry and the financial lens, so excited to be here with you today. We're going to talk about, again, those factors driving investors, and then also what you can do to prepare yourself if you are looking for some sort of business transaction. So some of the biggest factors driving deals today that I see, and by the way, another thing about my background, I do work with a number of companies who are going through some sort of merger or acquisition. So in my experience, what I've seen driving deals obviously is the financial value. If a buyer is looking to pick up another brand, there has to be some kernel there that is going to be accretive to the enterprise value of the parent company. So that could come in the form of a bargain purchase, which means that buyer sees target as having, an opportunity to pick up that asset at a less than fair market value for whatever reason. It could be that the target has a motivated seller. It could be that it's a distressed asset for some reason, and buyer sees that they could repackage the assets, shore it up, and make it healthy. Whatever the case may be, finding a bargain purchase angle certainly drives deals. Cash flow and liquidity are two basic foundational metrics that measure financial health. And cash flow being your cash conversion cycle, that is the period between cash going out the door and cash coming in the door, is quick, so you do have your cash flowing. And then liquidity being the measure of your current assets versus your current liability. In other words, you're well positioned to take care of your obligations as they come due. So it's a measure of financial strength, and both of those together are foundational metrics for financial health. So if there's a company out there that's a target and they're strong in these two areas, that is attractive to a buyer. It makes sense. It's a healthy asset, and so that could drive the investment as well. And then the ultra premium price points are proving to be really resilient. We see in data, and Emily touched on this a second ago, that the data shows that those price points are going to be able to ride the wave through an uncertain economic outlook. So they're much more resilient than other price points available in the market. And this could be seen as a benefit of adding financial value because it's an element of stability. So that financial value is definitely a factor driving deals, as is rounding out the catalog, which is the next bullet point. So consumer preferences are changing very rapidly. And if you're a large company, it's like being a big ship. You can't change directions very quickly. It's hard to kind of get innovation going sometimes. So you may see buying a smaller, more agile company as a strategic advantage because you can simply purchase the ability to pivot and be agile instead of trying to shift your own organization to meet that need in the market. Another way that acquisitions can round out the catalog is through technical aspects of creating a process that are unique. Again, this was something that was touched on in the last segment, is if you have a unique differentiation of what your product is or how it's made, that is very attractive as well. Again, from the buyer's perspective, it comes down to a make or buy decision oftentimes. So, a company is not going to be able to do everything organically themselves, or at least on a reasonable time frame, they're not going to be able to. So often they will acquire these new, capabilities by buying a company that already does that. So again, going back to the agile, being able to pivot, being able to bring new ideas and products to market quickly. Entry point for a new market. So if there is company A, and let's say this is a European company who wants to enter U.S. market, it may be interesting to purchase a U.S. company that already has an existing network of distributors and retailers, other business partners, that, company A in Europe may see that they could slide into that network. Now, it's not as simple as that in real life. You can't simply just slide another product into an existing distribution network, but it certainly helps the conversation if you own a brand that already has this network built out. So that can be very attractive. Also, if, again, same scenario, let's say there's European company who wants to enter U.S. market. If there is a facility in the U.S. with either excess capacity for production, well, let me back up. If there's a facility with excess capacity, Company A may purchase Company B and use the excess capacity to make their product and then get it into the U.S. market at an easier, logistics scenario. Or they may buy the company in the U.S., the production facility, scrap the original product being made there, and then use it for their purposes. But just getting closer to the ultimate destination of where you want your product to show up can be a strategic advantage that may drive deals as well. And final point of category stability. Some of the buyers in this world are funds where, it may be a fund that has a stake in multiple different industries, multiple different companies in various industries. And alcohol sticks around. Alcohol is recession-proof. And so it can be seen as something stabilizing to, if you've got your basket of investments, it may be seen as a more stable portion to round out your investment pool. So some of the factors driving deals today, and then turning towards the financial practices that companies can put into place to position themselves for whether it's an acquisition or a purchase, some sort of business transaction. There are a couple things that you can do to position yourself for that. First is, again, and this is just from the financial perspective, but adjust your chart of accounts to match that of a potential buyer. So some geographies are going to look at different aspects of the financials differently. One example is that in some countries, excise tax or alcohol-based taxes might be considered cost of goods sold, where in other geographies it's considered a contra revenue account. So it all comes out in the wash the same way. It's just how it's categorized on the financials. So making sure that you are able to present your financials in a way that is apples to apples to other people who you may want to do business with is important to have in line. Financial reporting structure is important as well. So you have your chart of accounts, which is basically all of the accounts available to you to categorize income and expenses, but that's different than your financial reporting structure. The financial reporting structure is presentation. How am I presenting this information to the reader? So an example is, let's say that I've got my operating expenses, and I could have everything under the sun in those operating expenses. It might be depreciation and office supplies and payroll and rent, and you've got all these different categories. It's important to present them in a way that you've got your big categories of expenses lined out. So I like to have general and administrative, sales and marketing, net operating income. Then below that, I'll have elements that contribute to EBITDA, such as interest, taxes, depreciation, amortization, with net income at the bottom line, and having it clearly spelled out so that, if I'm a buyer and I'm looking at a target's financials, I want to see what's their sales and marketing spend and measure that. And I might say, okay, I see this company is spending X% on sales and marketing. I believe if we can bump that up a percentage point, it might have an outsized effect on revenue. So it helps me analyze the opportunities better. Along the lines of financial presentation, your reporting presentation, you want to make sure that the gross margin for every revenue center is clearly stated. If you have 3 products, let's say a gin, a vodka, a tequila, you want to see, what's my gross margin on each of those products line, and there should be enough granularity in the financials to break out gen revenue, gen COGS, gen margin, because that is of critical importance. So if that's not already part of your financial reporting structure, highly encourage you to do that. Next point is around getting audited or reviewed financial statements. If you are positioning yourself to go through a business transaction, standard is to have 3 years of audited financials. And just so I can make sure we're all speaking the same language, assurance is when you hire an outside CPA firm to come in and review your books. They say, yep, what you're presenting here is correct. They're going to dig around, they're going to poke holes, they're going to assure that everything is accurate and complete and can be relied upon. So an audit or a review, those are two different levels of assurance that you can have. Minimum that you want to have is a review. An audit is the higher level of assurance. But if you can present to a buyer or some, could be a merger situation as well, but 3 years of that, it gives the business partner a lot more comfort that the results they see can be relied upon. Also, when you're going through the diligence phase, if you do enter a deal and you're going through diligence, it's going to speed that process from a financial perspective. There are, elements of legal that are still going to take a lot of time, but if you can have audited or reviewed financials, that will really quicken the process for you. And then finally, becoming familiar with available corporate structures and their tax impacts. You don't want to get to the 11th hour in a deal and then scramble to figure out how you're going to structure this, because you may end up with a really unfortunate tax outcome. So being able to, prepare your company and have a structure, understanding what that impact from a tax perspective will be, not only in a year of liquidation or wind down, but also what the tax impact will be in those ongoing years of operation is going to be critical. And it's important on both sides, both from a buy perspective and a sell perspective. So just understanding where you are, and also certain corporate structures might be more attractive to buyers than others. So thinking through what the options are and how it might impact down the road, So think about the tax impact and consult an advisor on that point as well. And then forecasting. Having a strong forecast is really important. This lines up your business plan and gives you a roadmap going forward. It helps a potential buyer see what the upside to this is. It helps them understand where you're going. If you have multiple years of losses and present that to a buyer, it's hard to see the silver lining. So let's say, and by the way, just having losses, that isn't the end of the world, but you do need to have a clear path to profitability. So when it comes to forecasting, this helps tell the story of your vision in a financial way. I recommend having 3 years of forecasted financials. In a perfect world, you would have a 3-statement forecast: balance sheet, income statement, and cash flow, but that is really advanced and not everybody might have the capabilities to do that. So you can cull it back just to a profit and loss forecast. Demonstrating increased profitability and top line, of course, is going to make you look good. However, you want to balance that with strong financial health. So as you're creating the forecast, also keep an eye to measurements such as debt service coverage ratio, liquidity, working capital that the business has, and making sure that you're still painting a picture of strong financial health, not just revenue growth. And then creating multiple versions of that forecast. If you have a decision between, or if you have an opportunity for 2 alternative paths, you might want to paint out one path in a forecast and then an alternate path in a second forecast, so that the reader or potential business partner can see the opportunity in both. So in summary, understanding what value you bring to the table, getting your financial house in order, and then also painting a picture of what the future looks like. Those are kind of the basic steps of what you need to do to prepare for some sort of business transaction.